Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by Betashare, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, Betashare manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with Betashare on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast.
Welcome to this episode of the Australian Finance Podcast. On Fridays, we love to do a Q&A session, and Owen is on some much-needed holiday time with his family. So I have Mitchell with us. Mitch, thanks for joining us.
Thank you, Gemma. Always a pleasure.
So you'll be familiar with Mitch from the Investor Podcast, and he is the head of funds management. Is that your job here at Rask? I think last time I called you an investment guru, and you're like, oh, let's simmer
down. No, so yes, technical title is the head of funds management at Rask Invest. So who do we serve? Essentially, it's people who want to invest, but maybe they don't know where to start, or they don't have the time or the energy to devote to it. And so we run a range of different investment portfolios where we predominantly invest in ETFs on behalf of people. All those portfolios have really specific mandates that they're trying to achieve. Jump on the Rask website, go over the investment side of things. You can have a look at the portfolios. You can even book a call with me. That is my shameless plug.
Absolutely love it. That's so good. So yes, you will see Mitch over a lot and hear his voice on the Investor Podcast. And yeah, he manages Rask Invest for us, which we're probably going to talk about a little bit today. As always, anything that we talk about is general in nature. It is not a recommendation. It's not personal advice. We don't know your needs, goals, and objectives. So very, very importantly, if we talk about anything like investing, like specific ETFs, maybe a super fund or whatever it is, we need you to make sure that you do your own research to make sure things are appropriate for you. If you're stuck, reach out, get financial advice. But this podcast is for information and education purposes only. But we always like to start these with a bit of a what's happening in your week. So Mitchell, what's happening on your week? I was actually going to ask you about your US trip, but you got roasted when you talked about it last week. You got trolled. So keep
I
it
wouldn't
short.
call it trolled. I wouldn't call it trolled. Well, some... I love YouTube comments. So the more the merrier. And someone did say, geez, this bloke has stopped short of showing us a bloody slideshow. So I did suggest that I could send him some pictures. So yes, I've just come back from a couple of weeks in the US, which if anyone listens to the Retirement Podcast or the Investors Podcast, you might be familiar with Drew. Drew owns an advisory company. He also owns a business called the Inside Network, which is kind of like an events business for financial advisors, wealth managers, fund managers, things like that. So every year they actually take a group of people across to the US with them, and they do, they go and visit lots of different fund managers, and they also then tie it into it always sounds weird when I actually say this, a finance festival. It's the most happening festival in finance.
Sounds nerdy. It sounds like I would love it.
It's so nerdy. So many Hawaiian shirts and bald heads.
Is that the highlight?
No. No, it was great. Thank you, Inside Network. No, the highlight would have been we did Boston, we did New York, we then did LA for the finance festival. It's called Future Proof. But the highlights would have been, we met so many really cool people in New York. I've just done a podcast with one of them. They've been in Australia this week. It's called Cola Capital. They do secondary private equity investment. That essentially is when you get private equity. Usually when you invest in private equity, you're in like one of the first kind of early rounds of funding. These guys come in and provide liquidity for people who want to exit those. So essentially they've been able to see how those businesses go. They've been able to, see if the business has got the runs on the board, if they're progressing, et cetera, and then make that decision to invest and provide that liquidity to people. So that's really cool.
Very interesting.
Yeah, so I had them on the podcast. So that episode hasn't come out yet. It'll be in a couple of weeks' time. But we met with them in New York. We met with PIMCO, got to see their trading floor and everything, which was really cool. We met with, this will be interesting, we met with the oldest private equity firm in the US called Warburg Pincus. And we had a presentation from them, and I got to sit on the same table as the CEO and just talk rubbish with him. It was fantastic, as I usually do. I asked him what his worst ever investment was from the private equity space. And it was a really interesting answer. It was a Formula One team. So they actually invested in and bought a significant chunk of a now non-existent F1 team. I thought that was really cool.
Wow.
Yeah.
So they won't be doing that again?
No. I think the person who did that's no longer with them. But so we met a lot of interesting people, did a lot of cool stuff. And yeah, it was it was awesome. I'll leave it at that.
No more thanks. Otherwise, we're going to need the slideshow of pictures.
Yeah, or I'll get myself in
If
trouble
anybody
too.
wants the whole hour episode of Mitch talking about his trip, it's on.
I thought you were going to say if anyone wants a slideshow. Please hit me up on the chat function on the Rask website, and I'll happily share some pictures.
Yeah, we'll get the media team to put together some slides for you. So this week I have a bit on. I'm squishing 5 days of work into 3-ish because I'm off to Sydney. Owen's already in Sydney. We have an event called Her Wealth, Her Way that we're going to. That's Mel Brown is running that. That's going to be really exciting. So we're there on Friday. And then I don't really want to jinx it, but I'm going to be on Sunrise on Sunday.
Are you?
Yeah, while I'm in Sydney, I'm going on Sunrise morning TV. But now that I've said it, what's about something happens and it gets cancelled? But I am so nervous about it. I've never been on TV before.
Right. Is this for your book? I presume it's for your book.
Yeah. I was to talk about the US trip I didn't go on.
All right.
Yeah.
I can give you some. I can give you some dot points.
It's to talk about the book. Let's talk about the book.
Cool.
So the podcast will get a plug, but yes, it was supposed to be on Saturday, but that's AFL Grand Final, so they've bumped me because I'm not as important as the AFL Grand Final. So now I'm going to be on Sunday.
So you're going to be. Look, I don't want to. So it's the day after AFL Grand Final.
Yeah.
And I'm sure there's going to be a lot of people up really bright and early.
Thank you. Yes. I am sure everybody, even know how hungover they will jump up to watch Sunrise and they will see me talking about the money reset.
Cannot miss TV. Gemma, I'm also curious, you've hit a certain milestone recently, a milestone that I'm approaching too. So this was part of it was last week now.
It was last week.
How was your first week of being 40?
Well, given that before we started recording, you said that I seemed the flattest that I've ever been, I'm going to say 40's knocked me around a bit. No, 40 has been great. I had the best celebrations, lots of just beautiful, people in my life, and I had a very good week, but the celebrations went on for a little long and my kids currently have COVID. It's school holidays. I'm trying to get ready for this Sydney trip and I'm hoping this isn't an indication how I'm just going to feel 40 from now on. I'm thinking it's just a hectic week.
We've, I think we maybe mentioned this on the last episode that we did, but there's a handful of us in the office all turning 40 within a couple of weeks of each other. So we're, geez, I hope it's not indicative, Gemma, because the productivity will go down with all of us hitting 40.
I want to be can't hire any more people around the 35 plus mark.
That's, certainly some key man risk there. Should we get into these
I'm
Q&As?
very excited to get into this. So today we have questions on franking credits. We have lots of investing questions, which of course I got because you're the investing guru. Where to start if you've got no experience at all. And some stuff about fees. So excited to get into it. The last few weeks, we've really had lots on debt recycling and first home super saver schemes. So I tried to kind of pull back on those and just get some investing ones in.
Yeah, I'm of almost no help first home super scheme stuff.
That's what I thought. And I'm just sick of saying all the letters. The name just drives me crazy. Okay, so first one we have from Salah. Salah? Can you please unpack franking credits? What have you got for us, Mitch? What are franking credits and what do we need to know about them?
Yeah, so a franking credit, right, is a tax credit attached to a dividend. So essentially, when a company, a stock, earns money, they pay tax on that, and then they pay out a dividend to you, which is a slice of those profits. And so the company has already paid the tax on those profits. And so a franking credit is a credit essentially to stop the double taxation on that money. So you don't, essentially it offsets the additional tax that you would maybe pay your personal income tax, etc. And so why franking credits can be quite powerful, and you might remember, listeners might remember the unlosable election that Labor had against, I think it was against Scott Morrison, and they started attacking franking credits. What was his name? I can't remember. Bill Shorten. Bill Shorten went after franking credits and lost the unlosable election. And essentially, why they're powerful is because if you are in retirement and you are not paying tax, you essentially get that credit back as a bit of as enhanced income, essentially. So, yeah, so that's what a franking credit is. It's just to stop double taxation. I don't know too many other countries in the world that actually have a franking credit system, and that is part of the reason as well why Australia, the Australian market as a whole, the ASX, is one of the highest yielding markets in the entire world, is because we've got this generous franking credit system and we've got a large superannuation system as well. So companies are quite incentivized to pay out a lot of their income as dividends.
Yeah, great. So for most companies, that's a tax rate of 30%. So essentially it's saying, here's, you get your dividend, and it says, but X amount of this is a credit for the company's already paid that in tax. And so if your tax, when the tax office calculates how much tax you have to pay at the end of the year, if it's higher than that, you pay a little bit of difference. If it's lower than that, you might actually get some cash back. And that's what happens at retirees. So when I was doing financial advice for retirees, one of the first questions was when they got to, retirement was, when can I stop doing a tax return? I don't want to do a tax return anymore. And really simple, if they had everything in super, then they could probably stop it because that was all in the tax-free environment. But if they had a share portfolio outside, a lot of the time it was still worthwhile that they had to do a tax return because they got these credits as money. So yeah.
Yeah, they're super, super powerful for retirees. And you even see some like investment kind of schemes set up to take advantage of that. They're kind of set up purely saying, hey, retirees or people with SMSFs, et cetera, this is an investment vehicle for you because we can take, or for people who can take full use of the franking credits. Yeah.
Yeah, great. Okay, next question comes from Anna. I'm sure that's a made-up name. We love our made-up names. Okay, could you please tell me what your fees are per year for an $800,000 portfolio? So before we jump into this, I had a couple of questions for Anna. I was thinking, is this a portfolio that the financial advice team recommend through a different kind of product? Is this Rask Invest? And then, we needed to talk about management, admin fees, all that kind of stuff. But I'm going to assume that this is Rask Invest, which is what you were talking about earlier, which you actually manage, and there's different portfolios. So let's assume it's not you going to a financial advisor and asking what the fees are or what investment product or platform and different things. Just let's pretend you're a DIY, you've got 800,000 and you've decided you're going to put it in Rask Invest.
Yeah, I think let's start there, and then I might throw back to you, Gemma, put you on the spot, and you give us the advice comparative.
Yeah, cool.
Yeah, great. So just so you can give people, because there's actually, I can see the questions that we've got coming up, and there is something about advice later on. And I think it's maybe a good little starting point and segue into that. So the Rask Invest side of our business, where we run portfolios for people, the bulk of our portfolios have a management fee of 0.55% per annum. The reason why I say the bulk, there are two that have, one has a higher fee, that's the Saturn portfolio, it's 0.75% per annum. And then there's a lower fee on the cash one, which I can't remember off the top of my head. I think
Isn't
it's
this your job?
It's 0.35.
But also check the PDS, make sure it's right for you, all of that kind of stuff. But yeah,
Exactly.
okay,
Yeah.
that's a good guide.
That's the management fee. Now, on balances above $500,000, we're actually able to discount. So just using, for example, the 0.55, because that's the majority of our portfolios, 0.55% per annum up to the first $500,000. The second $500,000, we drop that fee down to 0.25. Anything above $1 million, then we drop to 0.15. Now, so that's a tiered scale. So just answering this question straight up, into the 0.55, like so our Jupiter, Martian, Terra, etc. portfolios, based on that, you would pay roughly $3,500 a year for us to manage that for you. Now, when I say roughly, it's because we calculate the value of the portfolio every single day, and we break down that management fee into a daily calculation because the value of your portfolio is changing. It's the market's moving it up and down. You might add money, etc. So we want to get as accurate reflection of that as possible. But if it never changed, for whatever reason, it never changed value at all for the entire year, it'd be $3,500. That's the management fee. Now, of course, we use ETFs within our portfolios. And there's actually another question in here about ETF fees, so I won't go too far into it. But you do have, that's an underlying fee embedded in our management because that's embedded in the ETFs themselves. We pay really close attention to that. We have what we call a fee budget. So where we don't really want to get that too high. And so we kind of blend different ETFs. Some are more expensive, some are cheaper. And on average, I think it works out to be about 0.17% per annum. Now, when I'm talking to people about these fees, I'll say our management fee, and then I'll say our the indirect cost ratio, which is the ETF fees, and the brokerage separately, because if you were doing this yourself, you can't escape those fees. You can't escape the ETF fees. They're there, for using the ETF. And brokerage costs, well, they're there as well. Like even if you're going through the cheapest broker in the world, there's still some costs. We have a wholesale broker, and the charges are $4.40 per transaction, or 0.044% of the transacted value. So yeah, that's in a nutshell, that's the cost. So Gemma, the reason why I wanted to throw it back to you, say someone walked in the door to an advisor with $800,000, what are the typical kind of rates that they would pay?
Yeah, so if they were looking for financial advice, so what should I be doing with this money? How should I structure it? How should I invest it? They'll be looking at a financial advice fee for the advice to work with the advisor to get the strategy. And most firms, we typically see them start at around $5,000 and kind of go swiftly up from there. So it would depend on the complexity of their situation, but you'd be paying a financial advice fee. But then the financial advisor is going to recommend within that plan what structure it is, whether it's super, a trust, your personal name, company, whatever. And then within that, they'll look at a platform, just like the Rask Invest platform, or might be, if it's a super fund or a wrap, so there'll be the actual provider, like the administrator, and they'll have fees. And then they will be the actual underlying investments, like you said. And that could be ETFs, could be active managed, like whatever that is.
Could be managed funds. It could be, they could even do direct securities for you. So there's no essentially fee embedded in those, but they might charge you
initially and then nothing. So it really just depends on the strategy. But if you came into the financial advice firm, you'd be paying a financial advice strategy fee, and then you'd be paying for whatever the ongoing was when we decided what would the best product met your needs. But if it's a super fund, we generally say the 0.6 to 0.8% is kind of reasonable, like higher end, and they kind of go down from there. It really just depends. And, if you're investing in your own name in a wrap or a company structure, you'd probably look at about the same. Like, of course, you can get that so low if you're using ETFs and direct. But yeah, I don't really see too many alarm bells when I see people with management fees 0.6, 0.8, and they're getting a lot of value from it. Yeah.
That's the thing though, with a financial product, you kind of, what you're paying for is in the future.
Yes.
So with managed funds and whatnot, you won't know if it's a good idea until years and years down the track. So yeah.
That's exactly right. And making sure that review, like that it's not just set and forget, that you're checking in with these things as well, and making sure that it still suits your needs, that the tax structure and all of that is just as important as the underlying investments that you're going to put your money into. We do have a question about ETF management fees. Maybe we'll jump to that one. Does that make sense?
Yeah, sure. Did you want to say the name?
So we were having a debate on what this name actually meant, and Mitch schooled me. Okay, so this name is Lynching Charlie's Buffet.
Buffett.
Would we go Buffett? Yeah, because you think that this is the three names. Because I automatically went to...
You went dark and said, Jesus, we're talking lynching. That's terrible, which it is. We're not condoning that on the Rask network. But
so I went to lynching is about murder.
Yeah.
Charlie, I went to Charlie Rask, Owen's new baby, and then I went to buffet like food. But you have convinced me. You have clarified that these are three very famous investors, and that's what I should be jumping to, not
yes. So
this horrible.
I'm presuming the first name is referring to Peter Lynch. Peter Lynch is a very famous investor from the US who ran a fund at Fidelity called the Magellan Fund. And essentially he was like pretty much the highest performing fund manager for about 20 years. Exceptional track record. And he's written probably, I would say, probably the most iconic investing book called One Up on Wall Street.
Mm-hmm.
I've actually got a copy in my bag. I was rereading it after about 10 years.
I'd say it's second iconic after the money reset. Would you say that?
After the money reset, yeah. That's especially after you appear on the Today Show.
Sunrise.
Post AF. Sorry.
Nobody watched the Today Show until they get me on.
Okay. Switch over from Channel 9. Yeah, so Peter Lynch, fantastic investor. The book One Up on Wall Street is really, really good. And he kind of like walks you through how to use information that you come across every single day to make good stock investments. So the book, I think, was written in the 90s, and it's still so relevant today. It's fantastic. So if anyone's looking to get started like actually stock picking and analyzing companies, that is like, put that number one on your list to read. So anyway, so then Charlie refers...
Yeah, and then Charlie's?
Charlie refers to Charlie Munger, who was Buffett's right-hand man, who passed away earlier this year or late last year. And then, of course, Buffett refers to Warren Buffett. Charlie Munger is awesome. He's got there's a book called Poor Charlie's Almanac, which is all about the lattice work or the mental models that Charlie used to kind of talk about a lot. He's very much a psychological kind of playbook for dealing with life and business and investing.
Perfect. I will link all of those in the show notes. So if anyone wants to check out those books, you absolutely can. But the question from... we've spent more time on the name for the question. Absolutely love it.
Really quick answer here.
Okay. This one is about ETF management fees. I understand them. 0.40 on $10,000 invested would mean $40,000 a year. That's very general, but yep. But I don't understand how the money is actually taken from you. Is it via reduced distributions?
Kind of not. So it's actually accrued. Once again, it's like a funds management fee. They'll break that 0.4 or 0.5, whatever it is, percentage down into a daily calculation, and they'll just accrue it gradually from the unit price. Okay, and I don't know if it comes out. I know, like, if you read the PDS, it'll tell you exactly how it kind of comes out, the cadence of it. But most, say, managed funds do accrue daily and charge it monthly in arrears. And so that's how it kind of happens. So if you've got a 0.5% of a fee, it'll come out of your return at the end of the day. If the ETF is absolutely perfect in, say, tracking its benchmark. And so, for example, I've got an example here of $10,000 invested in an ETF at 0.5%. That's about $50 in fees for the year, right? So hypothetical, that ETF that index goes up by 7%. That means the $700 return. After the 0.5% fee, that gives you a net return of 6.5%. So you've got $650. So your balance has increased to $10,650 rather than $10,700. So that's if the ETF is perfect. So no other tracking error and stuff like that. So it's just accrued in the a really good example. If you want to see how things kind of accrue in an ETF, this is like, say, how dividends accrue in an ETF. So think of it as the inverse. But if you look at the Betashares, sponsor of the show, Betashares Cash ETF AAA, you'll actually see how the dividend every single day or week accrues. It looks like a little tiny step ladder because it's just a cash ETF. So it's just the interest accruing, and then the interest goes out and it drops it. And so it starts its little climb again and then drops and it starts its little climb. So it's kind of like that, the inverse of the fee, really. Yeah.
So on the opposite side of that, if the ETF is not performing, would the management fee is still coming out? So the
fees are still there.
The underperformance will be more under than the market because the fees also come out.
Yeah. So you'll get the return, the index return, whatever it is, or the benchmark return, whatever they're trying to get, minus the cost of the fees. So if they're under, then it's the underperformance minus the cost of the fees. Yeah.
Perfect. Okay. Hopefully that answers the question for lynching Charlie's Buffett.
I think we've said lynching way too many times on this podcast.
Okay, so the next I've grouped two questions together because they're very, very similar. So we have two questions here now. One is from New to This and the other one is Get Started. Great names. So I'm going to put them together because we will answer they're really similar. So New to This says, 0 experience. I want to start investing. Do I need a financial advisor? How do I say? Not sure what that part means.
I think they might be saying, how do I start?
How do I start?
I'm going to say it's a typo there.
Yeah. So 0 experience. I want to start investing. Do I need a financial advisor? How do I start? The next one is Get Started. What would you advise on getting started understanding investing? So I thought this was the perfect one to put together. My go-to was listen to this podcast, read the Money Reset. Actually, probably won't help that much.
This is the Australian advertising podcast, not the Australian finance podcast today.
When Owen is here, he drops the Money Reset every second word, I swear. He's good. He's much better.
Have you got him on retainer?
Yeah, pretty much. Okay, so my go-to was in the show notes, I'm going to link our ETF beginners course. It's just a free self-paced, really quick course, short videos, lots of great information jam-packed in there. So we've got an ETF one and a share investing course, both for beginners. I'll link them in the show notes. That was my recommendation. What have you got for us?
So do I need a financial advisor? That part of the question. The issue with it does also depend on where you are in your journey. The issue with financial advice and planning is that upfront cost. If you've just got your first decent paying job and you're just trying to put some money away and get going, well, you might not even be able to save $5,000 in a year, let alone go and pay an advisor to do that. However, saying that, I believe just this morning I actually saw, and I'll send a link to you, Gemma, to put this in the show notes as well. I saw a report from Vanguard, and it's just talking about the surveying their investors and those who did use a financial advisor and their confidence levels. And there's quite a stark difference in how comfortable people felt and how confident people felt, especially with retirement, based on whether or not they had a financial advisor. Like, spoiler alert, people with an advisor felt much more confident. They felt much more in control.
And
So
can stick to the plan. Yeah, absolutely. And it really will depend with this person how much, they've got zero experience, but they might have 100, 200, 500,000. So when I think of this question, I kind of think they're starting with, $5. Where do I start? But this might actually be that they've come into a lump sum of money, and financial advice is absolutely where you should be starting. And the advisor will help educate you. But if you're starting from kind of scratch, then potentially, well, I'm not even going to say potentially, like financial advice is going to be very hard to justify the advice fee.
yeah, so if you just want to get started actually investing, there's a lot of free resources out there, which Gemma has hinted at. And there's podcasts like this. There's a lot of other podcasts out there too. All of the good every single investor, like professional fund manager, has to release monthly, quarterly reports. They do webinars. They do all sorts of things. They write books like Mr. Lynch. That's why I know the stock picking game's actually really hard, because all the best people have actually written down their process and shown it to you, and yet it's really still incredibly difficult to replicate. So just start by reading widely, but if you're going to start with one single book though, and this goes for anyone who's wanting to pick stocks or whatever it is themselves, or just ETFs, read The Psychology of Money by Morgan Housel. I think that is just hands down one of the best books on investing, one of the best books on money and the psychology behind it, hence the name. He's got a really, really good quote on this. So he talks towards the back of the book. He talks about how he invests, and he uses index tracking ETFs, right? Even though he works for a venture capital private equity company. He uses index tracking ETFs like the S&P 500. And his quote is the reason why. He says, I can afford not to be the richest man in the world, but I can't afford... I can afford not to be the best investor in the world, but I can't afford to be the worst. So I thought that was really, really cool.
Very good quote.
So yeah, start with that book, and then you can look at, things like Raise, things like Perla, where you can start small. Already pre-made diversified ETFs like Vanguard and Betashare have them, etc. And you can look at how they all kind of put together, because they all follow a really similar methodology, that diversification across asset classes like Australian shares, international shares, property, infrastructure, etc. They all follow the same theory to put those together, so you can see how they do it. But you don't have to, try and do everything yourself. You can just start with like a Raise or a Perla, or just buying $500, which is the minimum parcel size, for your initial investment on the stock market into a diversified ETF, and get going from there.
Yeah, I think the key here is just to get started. Like when I find we talk to so many people and they're just getting started on their investing journey, which is so exciting, but they get that analysis paralysis. They don't know what platform, they don't know what shares. And we kind of go, just start, you'll learn along the way. But the longer that you sit on the sidelines waiting to have all of the answers, the longer you're going to be sitting out of the market, and the harder it's going to be to get in. I kind of just go, just start with a small amount that you're comfortable with, and learn along the way. And as you know better, you can do better, and you can always pivot. Like you might start with one ETF and then decide down the track that there's something else that suits you a bit better. You can add it. You don't have to keep going. You don't even have to sell the one. You could just stop adding to that and then move. You can just keep pivoting your financial, your goals and your strategy until you find something that feels really right for you.
Yeah. And going back to that analysis paralysis stuff, it's something I talk to a lot of investors about. The reason why they come and talk to us over at Rask Invest and use our services is because they really get bogged down in the detail, and they lack that confidence to make those next steps. And I kind of say to people, look, you can line up every ASX index tracking ETF, right? There's 4 or 5 of them out there. They all do roughly the same thing. Charge, the difference is fees, yada, yada, yada. You can get bogged down in that, or just pick the one that the name you like the best, because, and this is why I start with the psychology, it doesn't matter. All that analysis of ASX 200, 300, these fees, that fees, etc. will actually be meaningless if you eventually end up doing the wrong thing at the wrong time. So when the market pulls back, if you panic, sell out, etc., that 0.02% of a difference in fees that you've fretted over is going to be absolutely meaningless when you lock in that capital loss.
Yes, got to do the mindset stuff and the work. And like me, like I've been a financial advisor for 15 years and I still have a financial advisor because my money is so emotional to me. So I can help people as a money coach and a financial advisor see so clearly because I'm removed from their emotional decisions. So I need that for myself. Like I need that sounding board. And that's why I'll always have my super, like I will never self-manage my super. I'll always have a financial advisor that I use as a soundboard and get advice for, because we need to remove that emotional element. Otherwise, we do just sit in the sidelines second guessing our decisions.
Yeah. And that's like going back to that Vanguard study that I was just referring to, but also just my own experiences, just seeing what our investors do. They actually start investing with more confidence when we're managing it, and what that leads to is more money invested in the market, more savings going in, and more frequently, and it's just a really good compounding effect. One of the biggest mistakes I do want to jump back to is what we were talking about, like if you're just starting out. You can make mistakes. You can afford to make mistakes, if you're saving $1,000 a month or something like that. But if you've, some of the biggest mistakes I've seen in the past are like retirees who all of a sudden get bored. They set up at SMSF and they start wanting to learn investing. And they're not playing with $1,000 a month of savings. They're playing with potentially $1 million plus. And if you lose 5%, of that versus losing 5% of $1,000, it's a huge difference cash wise. And so what I call your tuition fees, you're going to pay them regardless because you're going to make mistakes when you're investing. It's actually part of the process. You want those mistakes, you want those tuition fees to be earned early on, to cost you early on, rather than later on when you've got a much bigger pile of cash.
Yeah, and a shorter time frame. That is very, very good. So mistakes is how we learn. We always, regardless if it's with our spending, our investing, everything, we're going to make mistakes along the way. It's just about kind of tweaking things until you get it right. But yes, I 100% agree. If you're going to make mistakes, you want to do it with a small amount of money. And that's where a core satellite approach can come in as well. You can go, well, this is my core, this is my slow, steady, proven comfort. And then I'm going to have a satellite approach where maybe I do invest in some things that are a bit more exciting for me, but it's not my whole strategy. And it's not going to be devastating to my situation.
Sometimes core and satellite does annoy me. How people, sometimes I would say most people, just generally speaking in the world, should just stick with core.
Yes, but you're always going to get people that want to get excited and want to do something. So I'm like, cool, you can do that. Let's just not do it with all your money. Let's not go all in.
I used to call that your sand pit. You can have the sand pit over there and you can do as you please. But what really annoys me is when I talk to people, and this terminology is used more often than I'd like to hear it. They will say, I've got my core and the satellite's a bit of a punt. They actually say, and in my world, every dollar's got a job. I do manage my own, say, super. That's my biggest pool of capital, because the rest is tied up in a mortgage. And every single dollar in there has a job. Mm-hmm. There's not a single punt.
Gamble. Yeah.
Yeah. So,
which I think is how we should think of our money, right? Yeah. But yes, I think if you're going to do it that way. Don't put it all on black or red or whatever they say.
Let's come back to it. Just because you could doesn't always mean you should. Build the core first, see how you feel about it. And then after a few months, after 6-12 months, when you're really, really comfortable, you've got everything nailed down, maybe some of those additional savings that you're putting in can go to something. So if you're building a satellite component, what that satellite component should be doing rather than punting, it should be adding diversification to your portfolio. So you might have, for example, your Australian share exposure is the ASX 300, but you also then want to add some small cap exposure to diversify that ASX 300 exposure. So you might add something there and make sure, it's well researched. I've done a couple of episodes actually, and Jesus, show notes are going to be having so many links.
Be longer than my book, The Money Reset.
I know. This is why I don't come on too often, because I'm so bloody long-winded. So I'll put a link to an episode that I did with I had conversation with a fella who invests a very similar way that I do, and he runs a managed fund that invests in other managed funds. And we talk about how we all pick managed funds. So I'll link to that. And so if you're looking at satellite exposure in an active sense, having this kind of process about how you actually select it, rather than just going, let's roll the dice on that.
Yeah.
So we'll link to that too.
Excellent. So that is all our questions. So we went through franking credits, fees on an $800,000 portfolio, but just in general, we went through how fees are actually deducted from ETFs, and we went through how to get started. Do you need a financial advisor, or is this something that you can do yourself? So the show notes are going to be huge with very valuable links, lots of different stuff in there. Put the report, we'll put the Betashares dividends so you can see the cute little steps that Mitchell talked about. I will link those books that we talked about. And yeah, it's going to be jam-packed. So if you have a question, you can also head to the show notes. You can put in, there's a link there for you to submit your questions, and Owen and I will get to them on a Friday. Mitchell, thank you so much for joining me on the Australian Finance Podcast.
No problems, Gemma. I will see you for our joint 40th.
I will see you in Melbourne very soon for that. I've already told Owen that the Rask credit card is going on the bar.
Absolutely. I've got one. Don't worry.
Oh, you've got a Rask credit card. Okay, great. I'm not trusted with one. I can't have one personally, and they won't give me a work one.
And I think that's fair.
I think that's fair too. All right. See you next time.
Cheers.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.